Good morning. Good morning to everybody. Very warm welcome to the second of our Spring Financial Fitness Fridays. I hope you're all doing well. Looking forward to the long weekend, I'm sure. I am Matthew Mitten. I am a colleague of Darren. I've worked with him for a long time and we work very closely together. So I'm standing in for him today. I'm pleased to say I'll do the best I can. We also have my colleague Leigh Mahoney, who is a financial planner at Foster de Novo, who will be joining us in a few minutes. We've still got quite a few people joining, so I'll just allow those other people to register and join us before I sort of get into the meat of the presentation. But whilst we're waiting for people to join, I'm delighted to say I think we had nearly 1,000 registrations for this session. So delighted that we're getting so much interest in something like this. For those that you have been to these before, you'll know kind of the backstory. But for those that haven't, it was an idea that came to us during the first lockdown. It was Joe Wicks, actually, who was the inspiration with his PE with Joe. And he was so inspiring. I thought, well, he's made fitness fun. Why can't we try and do something a bit more fun with our finances and see if we can help the nation's finances in the way that that he was helping people's fitness? We haven't got quite as many followers as Joe Wicks yet, but we'll try. So we are on YouTube. All the back catalogue is on YouTube. So do feel free to go on and subscribe to our YouTube channel. And also all the previous sessions that we've run on this if you haven't seen them before. So the format, the way we run this is they're 30 minutes where I'll be having an informal chat with Leigh. This isn't a sales pitch. This is not designed to try and sell you anything. It's very much to try and give you information and educational content that kind of help you maybe create some better habits. And give you some more information. I mean, my background is that I've worked in financial services for 25 years, and I'm particularly passionate about helping people with their financial well-being, and trying to get people to think about things differently, improve the way that they look at their money, and hopefully feel more in control of their finances. And I think that's the big thing really when it comes to financial well-being. If you think about what is the definition of it, well, quite hard to pin down, I guess, but for a lot of people, it's a feeling. It's that feeling of being in control of your money, both sort of like in the short term and also for the long term. For those of you that have attended previous sessions, Darren talks about the 4 pillars of financial well-being. The first of which is, living within your means. So this affects everybody at all ends of the financial spectrum. It doesn't discriminate between people that are high earners and low earners. It's easy to spend more than we earn. I'm sure we've probably all done it at times, but the best habits to get into is trying to make sure that we stay within our means. The second one is to have manageable levels of financial stress. So, that feeling of being in control again, knowing where money is going in, where money is going out, that helps to put things into control. Because living within that sort of those manageable levels of financial stress is much healthier for us. Mental health is a big aspect of our daily lives, and finances plays a massive part of that. We don't want to be waking up in the middle of the night worrying about money. How do we get ourselves to be within that sort of space where we are, living within that level of manageable stress? The third one is having firm economic foundations. So that's having an emergency fund, which we're going to talk about today. It's also about making sure we don't have any high interest debt. And thirdly is to try and make sure that our family's well looked after. So that's really the kind of the third aspect. And the fourth one, I think, which is also really exciting, is about having a wealth creation mindset. What I mean by that is having future financial goals, future financial objectives, but then actually having a plan to achieve those goals and objectives. Having a plan is really important. Again, it comes back to that feeling of control. Certainly, if we sort of hit some speed bumps, we can look at our plan and make sure that everything will kind of be okay in the end, because we have something that can keep us on the path. So Darren often again talks about psychology. So 80% of financial well-being is psychology. So that's about how we feel about our finances. And again, keep coming back to this thing about being in control. Understanding what we're doing with our money puts us in that position much better. It is easy to bury our heads, and that can start to create those feelings of stress that I've mentioned. The other 20% is the mechanics, the actual products, the things that the savings products, the pensions, the ISAs, the product, pension, the property, whatever it might be. That is the mechanics, and mechanics is all out there already. If you wanted to go and find some information, you can find it all on the internet. What we need really to give us that nudge to make those steps, hopefully, is a little bit of a a bit of persuasion in the right way to try and take those first steps. As I mentioned, getting ahead right is really important in order to be able to manage our mental health. And today we're going to be talking about getting the most out of our savings. So I think when we think about savings, the language that we use, we talked about emergency fund, but could be rainy day money, could be our nest egg. All of this evokes images of security. Something needs to be safe and secure. And I guess we all want a safe pair of hands to look after our money. And that's why I'm very pleased to say we've got a very safe pair of hands today in Leigh Mahoney, who's going to be our special guest to talk to us a bit more about savings. So good morning, Leigh. Are you there? Can you see me? Can you hear me? Can you join in?
I can, Matt.
Excellent.
Thanks.
Excellent. Thanks very much. I'm hoping everyone can see you too. And yes, I'm very excited about this morning. Obviously, standing in for Darren. Let's hope we can do him justice. So obviously in our line of work, we, quite often in lots of different scenarios, we'll get asked this question. But one of the most frequent one is, what should I be doing with my savings? I think the perception is everyone feels they could be getting a better return or something like that. They're missing out. What do you say to people that ask you that question?
Yeah, good question, Matt, and welcome to all. I think ultimately it really depends on how long you're saving, what you're saving for. But the way I like to sort of break savings down is to break it down into sort of 3 pots. So pot 1 typically would be your short-term money. So for example, it would be if you're planning on a holiday, although we can't travel so much these days, but if you're planning on a holiday, you may well want to save up for that, but that it's going to be spent in a relatively short period of time. You may have something, buy a car, etc. And typically that first pot, I would really sort of break down into sort of 0 to 5 years, really. So that would be my pot 1, and that would be any short-term spending, and that would be any sort of, if you like, emergency or buffer rainy day pot, so that if any unexpected things cropped up, money would be available that you could access without penalty, and sort of use that money, and then kind of over time you could replenish it again. So I think that's and I think as far as finances go, I think actually that's one of the most important pots, is that kind of rainy day short-term money. Ultimately, then we'll go to sort of pot 3 and think of long-term savings. So that could typically include pensions. It could typically include investments, although for people like me who are a bit older, perhaps pensions can be a short-term vehicle as well as long-term. So and that typically is retirement, perhaps, and beyond. Now, for a lot of people, that gap between 0 and 5 years and retirement can actually be a really long time. But I would class that as kind of pot 2. And typically you would then, anything sort of 5 years and beyond, I would throw into pot 2. And that's typically where money that you've got your rainy day money, you've got money set aside for any short-term spending, and this money is over and above what you require to have readily available. That could include investments, and that's where you start to maybe then consider investments which have an element of risk, which you want to try and achieve a better return. But typically those types of investments, you would look really for a term of saving beyond 5 years, because anything shorter than that, you don't want to run the risk of, if you needed it in the short term, that it had gone down in value and it was actually worth less than you'd saved. Inflation is a big factor when you're starting to save kind of longer term. I was at a lockdown birthday last year. I was 50. The kids bought me a little plaque with some costs on in 1970 on my birthday, and a couple of sort of things that I'll pull out from that which demonstrate inflation. The average house price in 1970 was around about less than £4,500, and quite something dear to my heart, a pint of beer was 18p. So you can see that the kind of inflation is a big factor if you're saving long term. And in terms of that sort of, if you like, emergency fund, we would probably look as a minimum to have roughly between 3 and 6 months of expenditure. So if you tot up all your bills and everything else as a readily available, really safe investment, 3 to 6 months of expenditure as an absolute minimum. Some people may want more than that as a sort of as a comfort, plus any short-term spending like holidays on top of that.
Excellent, thanks, Leigh. As you see, I think you probably saw the same question come in as I did as we were talking there. So it's a lovely prompt, because I was going to ask if you've got any questions as we go through, please use the Q&A box or the chat box, whichever. I mean, Q&A we're going to do at the end. So I'm going to have a quick dialogue with Leigh now for 30 minutes. And then for those that need to move on, go other meetings, that's fine. But there will be another 15 minutes at the end of this for Q&A, where, anybody who's got some questions that will come in, I'll be asking Leigh those questions. So feel free to use the Q&A box as well. But yeah, good pick up there about how much we should put in the pot one, about 3 to 6 months worth of cash. I think the thing about cash is just a comfort blanket. It makes us feel good about having that money there. It helps us to sleep a bit better. As you said, once you've got beyond that sort of level, inflation starts to eat into it. So you have to be a bit careful. So let's just have a little look at pot one. You talked about having cash. Obviously, current account is one place. You've got deposit accounts. You've got national savings. There's quite a lot of places you could put your money. How do you go about choosing one of those, particularly national insurance, because national savings, because there's quite a lot of choice out there?
Yeah, no, it's a good question. There is a lot of choice, and what we've seen enter into the market is a lot of challenger banks who sort of broke up the big four banks, and typically they're the ones that offer the better returns. There's much more opportunity, particularly for people that are comfortable saving online, to save online. I mean, there's Starling, Monza, there's lots of other banks out there, Chip, Virgin Money, all offer kind of different rates, typically a lot more than you would see offered by the big four, your Lloyds or HSB, NatWest, etc. And quite a good place to refer to is Martin Lewis's Money Saving Expert. It's a really good place to go on, have a look at what the best rates are that's on offer. It depends on whether you want instant access or whether you're comfortable tying your money up for a period. So most of these banks offer fixed term accounts, maybe 1 year, 2 years, 3 years, some even 5 years, where for an enhanced interest rate, as long as you're prepared to put your money away and not touch it or have limited access to it, they'll offer a slightly better return than just having it on instant access.
Excellent. And it wouldn't be it wouldn't be right to ignore the sort of the most talked about thing at the moment, which is cryptocurrency. I keep getting asked by people, should I be investing in things like Bitcoin and all that kind of stuff? What's your view on cryptocurrency, Leigh?
It's it's obviously very talked about. It's very relevant. Even as early as February of this year, Bitcoin kind of came into the news because Tesla decided to buy kind of $1.5 billion worth of Bitcoin. I think it's important to put it into perspective, though. So it is a relatively new currency. There isn't much historical data in terms of Bitcoin, for example. So therefore, it really is a speculative investment. And if we go back to the sort of Tesla example, then they've got around $19 billion sat in cash. The company valuation is around $700 billion. So even as crazy as it seems, they can afford to lose that level of cash without adversely affecting the business. So I think that's the way, as individuals, we need to look at it, as a speculative investment, and really look at it as, is it money that we can afford to lose?
Yeah, I think that's something that someone else said to me. It's a bit like they're sort of closer to gambling than investing, because it's very, very speculative, very volatile. And if you're happy to go down to the bookies and put a few £100 on a horse, then you'd be happy to go down and maybe put a few £100 on Bitcoin. It's that kind of level of risk. Obviously, it gets more mainstream when you've got Elon Musk talking about it. Although I read recently that he's not so keen on it now because of the environmental impact. So there you go. But I thought we'd better mention it nonetheless, just in case it comes up in the Q&A. You mentioned some fintech businesses earlier. You sort of name checked a few. I'm sort of a generation where I'm probably not quite there yet. I'm never quite as I prefer to stick more mainstream myself, but I imagine that my children are more into it, and I imagine there's some people who are listening in that would be interested on some of the fintech businesses. Any thoughts on that?
Yeah, I think anything that encourages people to save is a good thing. I'm probably like you. I'm probably the generation where I'm probably not as tech savvy as maybe my kids. I've got sort of two boys, 21 and 24, and without prompting, they use apps like Monza, they've used Starling Bank, they use Moneybox. One of them's got like an investment that he does. So I'm really sort of keen on those types of businesses entering in. It really disrupts the mainstream banks, makes it really easy for people to keep track of their savings. Those types of apps are really good for things like budgeting, telling you where you spend your money. It's at your fingertips. And generally those rates are better because they haven't got branch networks, etc. So you'll generally be able to achieve a better return. And also I like the concept of some of them where you might have seen it on the advert with some apps where you go and buy something like a coffee, and they'll on your app, Moneybox, for example, other companies offer it, where they'll round up to the nearest pound and then drop that into your savings. So it's just a really regular and a small way of saving, but it just gets you into that habit, which is, I think, really important.
And I think you really hit the nail on the head there. I think one of the things that people struggle with early on when they're looking to start saving is I don't have enough money. I get to the end of the month, there's never enough money. And I think some of these apps that are quite clever in the sense that they'll do the thinking for you. They will, as you said, either roll up the money. I know that the one I've got, for example, is Chip, and it works out how much I spend and takes some money out without me having to think about it. So that's great. And it also, I guess, plays into the philosophy of some of the greatest investors of all time. So Warren Buffett, for example, has always said, pay yourself first. And there's a great book I read recently, Richest Man in Babylon by George Clason. Recommend that to people. It's a light read, a couple of hours, doesn't take very long. But his philosophy is if you save 1/10 of your earnings, you should do that first. Pay yourself first and live on 9/10, and that will sort of probably see you right. So thanks for that. We talked a little bit about short term there. Hopefully that's been helpful for people. I'm ever conscious of time. It's amazing where the time goes. Moving on to sort of pot number, I'll call it pot number 2 because medium term in terms of timeline. Most people when they start saving more medium term, beyond cash deposits, look at things like ISAs. However, when people save into ISAs, the vast majority of them just leave it in a cash ISA, which would probably indicate there's either lack of appetite for risk out there, or there's a lack of understanding of investment risk. What would you say to people looking to invest in, the stock market or stock market ISA for the first time?
I think, again, for that, for where you've earmarked that you can save for longer and you're comfortable taking an element of risk. And I think it's important when risk is quite an emotive word. So it's important to understand that there are lots of degrees of risk within investment ISAs. So it's not, there's various scales. Saving regularly can also be a benefit of entering the stock market. So it doesn't necessarily have to be a big outlay all in one go. If you save regularly, generally, if you think of the stock market as a sort of roller coaster, there'll be periods whereby it's up and down. By saving regularly, you can kind of even out those ups and downs. And that's called pound cost averaging. So that can be a really good way of entering the market without a big outlay, but benefiting from those better returns for that pot 2 that we spoke about.
Yeah, I think it's fair to say if we were sharing charts and things, there's quite a lot of evidence that suggests if you're in the stock market for the long term, that tends to perform nearly always better than cash, and certainly nearly always better than inflation. But you've got to be in it for the long term. As you said, minimum 5 years. The usual caveats apply. I can't guarantee that, but that tends to be the case. And I think your point about regular investing, that does help to sort of smooth out some of those peaks and troughs, doesn't it? Which comes back to another point. People often talk about timing the market. They feel like to be an investor in the market, I've got to get the time right when the market's at the bottom and all that sort of stuff. What's your view on things like that, timing the market?
Good question. Absolutely impossible to know where the market is in terms of, is it at the bottom, is it at the top? So it's always important time in the market rather than trying to time the market, because that is impossible. So if you're investing for the longer term, it's how long you're prepared to invest for, because the longer you invest for, that is a natural reducer of risk. So, don't try and time the market, because that's impossible, I would say.
Yeah, exactly that. And again, I'll refer to Warren Buffett once again. His philosophy was to buy and never sell. He always said, look, I just want to buy. I look for long-term investments. And now the great thing about investing in, modern days, you don't have to pick a particular company. There's lots of funds out there, aren't there, which are made up of all these different companies. And again, that helps to reduce your risk, because you're not over-reliant on one company to do well. You're basically spreading, that old adage of not putting all your eggs into one basket. Interesting, whilst we've been talking, there's a couple of things coming on the chat here. I'll just read out a couple of points here. Some strong support for some online banks and Monzo, etc. Many great developments that have now been adapted by the mainstream banks. That's true. We're seeing, that's what disruptors do, isn't it? I've got a fan here of Chip that currently has an instant access account paying 1.25% up to £10,000. So that's pretty good. I think best rate, she said, that she found online. And sorry, someone wants to know the book I recommended. The book is called The Richest Man in Babylon. Richest Man in Babylon, and it's by an author called George S. Clayson, Clason. So you can get that on Kindle or Amazon or anything like that. Great, and we talked about short term. We touched about medium term. There's a couple of questions in here which I'll come back to at the end, perhaps. But the longer term as well. I mean, pensions is obviously talked about a lot. We do a lot of series on pensions. I don't want this to be a pensions talk, but people often say, what about property? That's quite a good long-term investment. And certainly if you read the newspapers, it only ever goes up. Should we be investing all our money in property instead of a pension?
I hear this all the time. I think people like property because it's a physical asset. You can sort of drive past it and see your physical asset, whereas stocks and shares, it's you see it on a bit of paper. The reality is that property is just like most other investments, that it has periods whereby it's strong and periods whereby it has difficult periods in the market. Property itself, you need if you buy property outright, you need a deposit. Typically, unless you're very lucky, there'll be a mortgage secured on it. You would look to let it out for a return and hope get an income from that. But you're then relying on regular good tenants that pay well, look after the property, and there's quite a lot of upfront cost in terms of property. There's costs when you come to sell it in terms of capital gains tax. So it's just like any other asset. You just need to consider the costs, and it can go up and down. But it can be a very good investment. And there are funds out there, property funds, where for those that don't have enough money necessarily, or don't want to tie all their money up into one property, you can invest in property funds where, for again a small outlay, you can invest into a property fund that then invests into a diversified portfolio of properties.
Yeah, I think we tend to invest in things that we like, don't we? Things that we understand. And I guess for most people, the stock market can seem a bit risky, a bit. You see the news every day, and stock markets, either gone up or plummeted or whatever, and you can get rather disturbed by some of that news. And you can see why people might think about other things. But I guess I think what I'm hearing is on these things, and what we tend to promote as financial advisors is, a broad spread of investments across a range of different assets is going to give you, a better chance of a decent long-term return. Now, it's interesting starting getting some questions on here, which I'll share with you in just a minute. But certain things like, what is a good return? What should people be expecting? So if we can only get 0 or 1% or something like that on our cash savings, what kind of return should I be expecting if I did put my money into an ISA or something else?
Good question. I think what generally most people are looking for is a return after sort of charges and inflation that produces a positive return above what they would expect in cash after charges. Because there has to be a premium on the return to compensate for the level of risk that's being taken. So
in plain English then, because there's a little bit of jargon in there about premium on investment return and stuff like that. So if I was to say to you, I'm just, depending on the level of risk you're taking, clearly will impact the amount of return you're going to get. But, is it reasonable to expect, say, maybe a 5% return over a year after 5 years if I was invested in the stock market? Is that unreasonable? Or should I be expecting 10%, 2%? I know it's very hard to nail down, and it clearly depends where you invest. But I think just to sort of give our listeners an idea of what kind of range you might expect for, say, a medium risk investment.
Yeah, good question. I think roughly on average a 4 to 6% return for a broadly medium risk portfolio of it's quite well spread, not all your eggs in one basket. Yeah. Fairly mainstream. Yeah, 4 to 6% a year on average.
Okay, which is great. And clearly that comes with the caveat that the money can go down as well. We know all of that sort of thing, and but it does sort of start to look quite attractive when you're looking at the interest rates that you can get on bank accounts if you've got that longer term time horizon. So we've got about 2 or 3 minutes left. So I'll ask a couple. I've got some more questions coming in here, and then just before the end of 11:30, and before we move to the sort of Q&A proper, if you like, I just need to sort of let people know there's another session coming up, which is more about investment returns. Actually, let me just share my screen with you so people can see that the next session that we've got coming up is how to get don't miss next Friday's session, which is investment trends and insights. So we've got a regular guest speaker, Jamie Smith. Some of you may have heard him talk before. He'll be introduced by Darren. He's back from his little break, and we have some usual risk warnings that I'm required to give you as part of our compliance team. Would insist that I ensure that I make sure that has been shared. So we've got a couple of minutes now before the end of 11:30. So I'm just going to ask you some questions in here. I'm not sure if you've seen them come in as well, Leigh. So just not in any particular order. If inflation is higher than savings interest rate, is there any point in saving?
Yeah, well, I think it again becomes, it's important to have that emergency buffer, that rainy day savings, because you never know what unplanned, life is very unpredictable. To have that cash buffer allows you to access savings for those unexpected expenses, and it avoids the need to borrow at perhaps much higher. Borrowing is generally much more expensive, so I think it is important to still save, but to have I think it goes back to your original, is to have a plan. What are you saving for? When is the money needed? And therefore, then you're to make sure that you have the right amount in each of those pots working for you. So not to have too much in cash, because then it's working against you in terms of inflation and costs, but also so it's to know what you're saving for, and ultimately the timeline, so that you've got the right money in the right place.
I've got a question here about premium bonds from National Savings. Any thoughts on those?
Lots of my clients do hold premium bonds. It's quite nice to get the prize money. I mean, the
Yeah.
rates have, like most things, rates have been cut, but I know clients like the thought of premium bonds. One, they're very safe. They're backed by the government. So in terms of the normal 85,000 sort of compensation level of protection, should the bank go under, that doesn't apply to national savings. So you can hold much more in national savings and be secure, or is there a limit with premium bonds? So yeah, I think premium bonds is a good way to hold cash, if you like, that is.
So just very quickly, Leigh, a premium bond, I think it's just explain how it works. It's slightly different to a normal investment where you get interest, isn't it?
Yeah, absolutely. So you put the money away. It participates in a prize draw, and you get the opportunity of winning, if you like, on your certificates. And you see that's your return. So if you're very lucky, you'll get a very good return. If you're unlucky, then obviously you may not see anything. And it quite often depends how much premium bonds you've got. If you hold the maximum 50,000, then you quite often, my clients see a regular supply of interest, if you like, although it's not interest, it's winnings coming through, and they do like that.
Great. Okay. Well, obviously it's not for everybody. There's I guess dealing with national savings itself. I've got someone in the chat there looking. They've had a poor experience in terms of admin. I know that it can be done online, which makes it a bit easier. But again, it's probably for people to make their own choices on that. Which leads me to another question. And I'm conscious we now have done the half an hour, so for those people who need to move on, obviously thank you for joining. But if people want to stay on for the Q&A, I've got lots of questions coming in. And we'll keep going for another 15 minutes or so. I guess there's so much choice out there. We talked about the money saving expert with Martin Lewis. Is there any other places that people can go? I think it's a concern here that people might get scammed, or that they might be putting money into something that they could lose all their money in. How would they sort of vet any of these sorts of things before making any sorts of commitments?
I think it's important to sort of check what level of compensation, are they part of the financial services compensation scheme? It's important to do.
So again, sorry, just to interrupt you there, Leigh. Sorry. So you mentioned earlier about £85,000 as a protection. Just quickly explain that to the listeners.
So should the bank kind of go under and become insolvent, people's savings are protected by the compensation scheme, so that they would ensure that they get their money back up to a level of £85,000. Now it's important. Some banks share the same license, so you may think that you're investing in two separate banks, and actually they're under the same license. So therefore, it's just important to check that level of compensation, so that that your money is secure. And lots of clients tend to with lots of cash, tend to use more than one bank, because after the 2008-9 banking crisis, while nobody lost money in the UK banks, that it made them very nervous about the security of banks.
Yeah. Okay, that's helpful. And I think it's slightly different if you're invested in something that's an insured fund. Am I right that there's in some ways a high degree of protection, or above 85,000, you potentially get more money back? Am I right with that? Or
yeah, just typically it's 90% on an investment with no upper limit, but it comes under a different compensation scheme than your cash deposit savings.
So I think the thing to look out for, it would seem, is to make sure you're investing in a regulated investment. To make that's the thing. If it's regulated by the FCA, the Financial Conduct Authority, or the PRA, which is Prudential Regulation Authority, I think is the name of them, that gives you a high degree of protection. Back to the point about scams, there are people out there that will pretend to be from these people. I guess you have to always have your wits about you. Lots of pension scams out there, in particular, asking people to withdraw their pensions, invest in property overseas. It's been quite popular. If it looks too good to be true, then the chances are, that's probably a big warning sign.
Yeah. I think, again, Matt, I think if anyone contacts you, in terms of investments or savings, I think that would put a red flag up in terms of in terms of scams, because a reputable organisation doesn't phone up out the blue and offer returns. And it's the old adage: if it seems too good to be true, it probably is.
Yeah, exactly. Excuse me. A couple of other questions here. One about whether you should try and pay off your mortgage, as interest rates are pretty low on savings. Does it make sense to try and clear your mortgage before investing? And therefore, ultimately you getting more money from your property?
I think when mortgage borrowing was much more expensive, I think people were keen to pay that off quicker. And I still think mortgages, whilst their money is cheap, is still a debt. And I think psychologically, a lot of people like to pay down their mortgage as quickly as possible. But I think it's about getting the balance right in terms of if you've got money to pay off the mortgage, it's also important to have a longer term objective. And sometimes it can be a balance between paying the mortgage off and saving. It's not all about necessarily redirecting it to pay the mortgage off as quickly as possible.
Yeah, thank you. And sort of subsequent question, really, which I think we sort of talked about, really, but it's that someone's saying, should I pay more of my mortgage off or use that money to invest in my pension? And I guess, it's difficult because obviously each person's individual and there are significant tax advantages for pension investments. The tax relief that you get, particularly for a high rate taxpayer, can be very attractive. So I guess, it's hard for us to give specific answers to some of these questions without sort of straying into kind of individual recommendations. So question here, actually coming, that 85,000 limit that you've talked about protection, does that apply to stocks and shares ISAs that are held at a UK bank?
So no, because it's an investment, it comes under a different compensation scheme and therefore would come under the 90% with no upper limit as an investment rather than as a cash savings account.
Great. I'm also conscious that we may not get a chance to answer all the questions as there's still quite a few on here. So we will come back to you individually if we can following this session. One of the things that I'd really ask maybe from all the audience is to give us some feedback at the end. So when this session finishes, you'll be shown a link that will take you to a feedback form. It's not very long. It's not like the premium bonds, I'm pleased to say, but it's a very short form. And what we're really after is, your thoughts on today, but also any constructive criticism that you might have. We really want to hear about it. We also really want to know what you want to know more about next time. So all of these sessions that we're running over the next 2 or 3 weeks have all been based on the feedback we've had on the previous sessions. So if there's subjects you want us to talk about, please let us know in that feedback, and we'll do our very best to make sure we can get guests and hosts on to address those issues. Okay, so let me just have a quick look to see what other questions we've got here. What is your opinion on using credit cards as an emergency buffer instead of keeping cash? That should give some time to withdraw invested cash if necessary.
Credit card is one of the most expensive forms of borrowing. So I would obviously, as a short-term measure, as long as it's only short-term, it can work. But I would much prefer credit cards to be used in that way rather than rely on them as a means to your only fallback option is to put it on credit card. So they're those one-off bigger ticket items that you can pay off relatively quickly rather than incur expensive interest.
Right, thank you. I'm just having a look here. There's one here that says, what's our take on the pension changes and the impact on investment approach, whereby in previous generations, you tended to reduce your risk as you approach retirement and then buy an annuity, which is a guaranteed form of income. And you don't have to worry about investments then. Nowadays, there's a lot more flexibility, and a lot of people approaching pension age are going to remain invested and drawing down their funds, which gives you time in the market, but obviously has some investment risk associated with that. So what are your thoughts on that level of risk for pensioners?
So I think there is much more flexibility around pensions, absolutely. And I think most of the big providers, so those that provide the big workplace pension schemes, have kind of adopted that. And now typically where they reduce the risk, you have the option of reducing the risk to tie more in with that flexibility. So rather than buying an annuity and have an investment approach where somebody is going to swap their pension fund for a guaranteed income for life, it will now revert to a strategy that the insurance company or the pension company will adopt automatically, where somebody is more likely to keep their money invested and just draw down every year what they need to fund their lifestyle. So generally most pension schemes have that option of a drawdown, which is that flexible approach at retirement. So it doesn't necessarily de-risk altogether, but it de-risks slightly as someone gets closer to retirement and makes some key decisions.
And I'm right in thinking as well that you can mix and match. You can buy some of your pension fund as an annuity to give you that peace of mind of security and knowing that's guaranteed, and then some of it can remain invested. Is that right?
Absolutely. Some people like to know that their basic costs are met through guaranteed income, and therefore it enables them to their discretionary income, if you like, enables them to take an element of risk and be able to dip in and dip out, whenever they need maybe some additional expenditure.
Excellent. We talked quite a lot about different types of investments. I think there's a question here about investing into index tracking funds, which I think is a really good, potentially a really good way of someone doing their first investment. Got a few questions here about, I've got some money, we're looking to invest for the first time. There's so much out there and there's so much jargon and things to cut through. Could you maybe just explain what investing in index tracking funds is versus maybe managed funds and actively managed funds, and what the benefits and drawbacks might be of both of those?
Yeah, so index or tracker funds, as they're sometimes called, aim to just track an index, like, for example, the FTSE 100, the FTSE 250, for example. So they're not trying to...
Sorry, Leigh, just to point out, the FTSE 100 for people, in case they don't know, is the largest 100 companies listed on the UK stock market. The FTSE 250 is the largest 250 companies. So by doing that, you are investing in 100 companies in the UK, or 250 companies, and you could be investing as little maybe as £20 a month, £50 a month, or £1,000 to get access to all of those funds through an online tracker. Is that right?
Absolutely. So it's a good low cost way of accessing the stock market. So again, some people, cost is a real key factor. So it's, as I say, keeps the cost down, whereas actively managed is where a fund manager is really looking for perhaps companies that are undervalued, or where there is additional growth potential to invest into those stocks. And active managers aim to actively outperform the index so that they can show value, because they typically would charge more for that type of management because there's more research involved.
And when we're talking about charges, I mean, just explain quickly how charges work, because you don't see charges in a bank account in the same way that you do with investments. So just explain quickly, if I was investing, what charges I would normally expect to pay.
So typically you would pay, there is a process or a mechanism. So for an index fund, you would probably expect to pay between half and quarter of 1% and 0.5%, something like that.
Of the money that I've got in that fund, is it as an annual charge? As an annual charge. Right. Okay.
Actively funds, you would probably expect to pay something between probably 1.25% and probably 1.6% a year. And right. You would hope and expect that for that additional cost, that it performs greater than the index funds, because obviously there's more of a cost to that.
Absolutely. So just to put that in context, if I was paying 0.25% on £1,000, it's costing me £2.50 a year to have that money invested, which, you know, doesn't feel that expensive to me. Obviously, if you then start looking at active management, 1%, 2%, obviously that's significantly more. Great. I think I'm going to have to ask you to pause there, Leigh. I'm afraid we've come to the end of our Q&A session. We've done 15 minutes. We do have other questions on here that we haven't had a chance to answer. So my apologies that we haven't answered all those questions. Please do fill in your feedback form at the end of this session when we log out. I hope it's been useful for you. It's certainly been a pleasure talking to you all. It's been a pleasure talking to you, Leigh. Thank you very much for giving up your Friday morning. And yeah, we look forward to welcoming you back in a week's time. In the meantime, enjoy the long weekend, everybody, and hopefully the sun will shine. And we'll look forward to seeing you all again, hopefully in the not too distant future. Thank you.
Thank you.